Intuit just pulled off their biggest quarter of the year. They hauled in $8.56 billion and then immediately announced they are firing 17% of their entire workforce.
Right. The brutality of scale at its finest.
Exactly. Welcome to Earnings Unscripted, everybody. It is May 20th, 2026, and today we are unpacking Intuit, ticker INTU, and their frankly wild Q3 results. Oh, and just to get out of the way early, this is just our personal opinion, totally not financial advice. Please do not trade based on our banter.
No, definitely do your own math, especially today because, well, the math on this print is a little schizophrenic. You look at the raw results, revenue up 84% sequentially from Q2, operating margins spiked to 47%. They generated over $5 billion in free cash flow. It looks like a masterpiece on paper.
Well, it is peak tax season. I mean, they practically own that space with TurboTax and QuickBooks, so you expect a spike. And their GAAP EPS came in at, 11.09 a share, up massively from $2.48 last quarter. You see those numbers and you would think the stock is about to fly.
But it tanked. The stock had already drifted down like 20% over the quarter, which is a rough baseline. And then right after this release, shares just fell off a cliff in after hours, dropped over 16% straight down into the 330 range.
Okay, so help me connect those two things. You have record cash flow, massive tax revenue, and the street absolutely hates it. Is it just the mass layoffs spooking everyone?
The layoffs are the symptom, not the disease. The market is looking at where the structural growth actually broke. Yes, the premium assisted tier for TurboTax did great, but the CEO flat out admitted on the call that they completely lost on price in the low-end do-it-yourself tax market.
Right, for filers making under $50,000. He literally used the phrase, "we lost on price,"
right,
which is honestly a rare moment of clarity from a CEO. Normally they call that macroeconomic headwinds or something.
Exactly. Free competitors just ate their lunch at the bottom end. But the much bigger anchor, and probably why the stock is really taking punishment, is Mailchimp. That was a $12 billion acquisition, and revenue there was actually down slightly year over year. Management is basically waving the white flag. They are demoting it to a legacy asset and managing it purely for cash flow instead of top-line growth.
Wow, treating a $12 billion growth engine like a mature desktop app, that is a heavy, heavy pivot.
It is. It throws a real shadow over their whole small business software pitch. You combine stalling software growth with a $300 million restructuring charge for these layoffs next quarter, and suddenly the guidance looks incredibly messy.
All right, let's get into the details on all of that because the underlying strategy shifts they're making to survive this are fascinating.
Yeah, the most revealing pivot is definitely at the bottom of that funnel. Because look, for years, tax software just dictated whatever price it wanted based on how complicated your tax return was.
Right. It was entirely complexity-based.
Exactly. If your life got slightly more complicated, you paid up. But they are completely scrapping that for lower-income filers. They are moving to what they call value-based pricing, which is, a nice corporate spin.
I feel a but coming.
But mechanically, they are basically having to use the actual tax software as a loss leader. I mean, they practically have to. They lost those sub-$50,000 earners. The actual profit going forward is going to come from cross-selling what they call fast money products.
Okay, wait. Fast money. You mean like the refund advances and those immediate cash loans?
Yes, you get the filer in for free or very cheap, and then you offer them their refund immediately, just for a fee or a cut of the total. And the adoption there is actually staggering. Over 35% of TurboTax filers use it now.
Wow.
So they are effectively saying, we cannot charge you for code anymore. We have to charge you for liquidity. Sachin Gudersi, the CEO, literally said this on the call, quote, ultimately customers buy confidence, not code.
Confidence, not code. That is actually brilliant marketing, but it also feels like a huge identity shift. You go from being a software utility to essentially a short-term consumer lender at the bottom end of your market, which is, I guess, where the real money is.
That is exactly where the money is. Cross-subsidization at scale.
It makes sense on a spreadsheet. It is just a little jarring. You have a company pivoting its core consumer product like that. They just printed $5.2 billion in free cash flow, and then they unceremoniously fire 17% of their staff? Like, how does a company running that hot just cut almost a fifth of its people?
Well, the obvious assumption in the media right now is AI. Everyone immediately jumped to this narrative that GenOS and their accounting AI agents are doing so much work now, they just fired the humans.
Right. The robots are finally taking the project management job.
No, but that is the fascinating part. It is not the robots. Management went out of their way to squash that rumor. Goodarzi was extremely direct. He said, let me tell you what this is not about. This was not about AI.
Really? Then what was it about? Just pure cost-cutting for margin padding?
Mostly, yes. He specifically targeted coordination-heavy roles, so project management offices, business operations, layers of middle management that essentially exist just to manage other managers. Plus, they are finally merging the duplicated roles from the old Credit Karma acquisition.
Jeez. So it really is just corporate bloat. That is almost more brutal in a way. You build up these massive coordination layers when capital is cheap, and then the second your top-line growth wobbles in certain segments, like we saw with Mailchimp, you just amputate the middle of the org chart.
It's the reality of the software lifecycle. Growth masks entropy. When you're growing revenue at 30 or 40%, nobody cares if you have 5 people coordinating a single product launch. When software revenue growth stalls, suddenly that coordination looks very expensive.
Growth masks entropy. You should seriously put that on a t-shirt, Miro.
I think I already have it on a coffee mug somewhere. But look, speaking of things stalling, there is another piece of data in here that kind of highlights a weird reality check for their core business. I'm looking at the ProTax segment. This is the software that actual accounting professionals use.
Right, their bread and butter, the heavy-duty stuff.
Yes. Q3 is the absolute heart of tax season. It captures everything leading up to April 15th. And yet, sequential revenue for ProTax actually fell. It went from $290 million in Q2 down to, let me just double-check this, down to $278 million in Q3.
Wait, that makes zero sense. Why would professional tax software revenue drop in the exact quarter where accountants do literally all their work?
Exactly. It stands out like a sore thumb. And they did not really give a great structural excuse for it in the commentary. You combine that with them talking about a massive drop in manual filers this year. They realized a huge chunk of people who usually file paper returns just gave up. They said the total macro ecosystem lost almost 2 million expected filers. People just opting out.
2 million people completely tapping out of the tax system? That is wild. Okay, so if I'm putting this together, they're squeezing fewer people for more money using liquidity tools. They're pivoting the DIY base to payday loan style products and carving out the middle of their org chart to defend their margins.
That's the math. It's highly profitable math right now, but it's fundamentally defensive maneuvering.
So where does this leave them heading into the rest of the year? With that $300 million restructuring charge looming next quarter, how is Wall Street supposed to value this new version of Intuit?
Well, I think Wall Street has to decide if they care more about the transition noise or the actual cash machine. Because looking ahead, they explicitly raised their full-year guidance on this call.
Oh, really? Even with the big severance hit coming?
Yeah, exactly. They are projecting full-year revenue growth of 13 to 14%. So they're basically saying, look, Q4 GAAP earnings will look completely terrible. It is dropping to like 70-something cents a share, specifically because they're paying out that $300 million for the layoffs. But the non-GAAP run rate is still projecting huge strength.
Right. So the underlying engine is still humming, but if the classic software subscription model is stalling out, like we talk about with Mailchimp, what is the new growth lever next year?
It is the accountants. This is probably the most interesting forward-looking detail they gave. In August, they're launching new intelligence tools for professional accountants, but they're testing a consumption-based pricing model instead of just traditional flat SaaS subscriptions.
Okay, wait. Consumption-based, meaning totally uncapped revenue if the usage goes up.
Exactly. You charged based on how much the accountant's clients actually utilize the ecosystem. The CEO had this quote. He said, "We are treating accountants like customers to actually get them to accelerate the number of users they bring onto our platform. You're basically weaponizing the local CPA to be a commissioned salesperson for Intuit."
They're insanely pragmatic. So let me just step back and look at the whole board here. They're hacking off the middle management fat. milking their expensive acquisitions for cash, pushing low-income filers into immediate lending products, and now they're turning accountants into a direct sales force.
It is peak tech maturity, honestly. The whole hypergrowth era is completely dead. We are now strictly in the extraction phase of the cycle.
The extraction phase. It sounds a little dystopian, but definitely fits the math. Definitely a rough week to be a project manager at Intuit, but a really fascinating corporate evolution if you're watching from the outside.
It is just capital discipline in real time.
Fair enough. Well, I think that's a pretty good place to leave it for today. Always a pleasure dissecting the madness with you, Miro.
Talk to you next quarter.
Thanks so much for tuning in, everyone. We'll catch you on the next earnings call. And hey, if you want these earnings breakdowns to just show up in your feed, go ahead and follow the show. Just a quick heads up that this entire podcast is actually generated by AI, right down to the synthetic voices you're hearing right now. But we still really want your actual human feedback. So if you have thoughts or a specific ticker you want us to cover next, just shoot a note to earningsunscripted@datamadness.ca or grab that X link in the show notes.
Catch you on the next one.